Hello and welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at The Australian. Welcome aboard, everybody. I just said earlier this week, I was talking to a former colleague of mine who is quite across economics, finance, property. And she said to me she thinks house prices are going to fall next year. She's read a few reports, research reports that are saying that, and they are out there, they're getting attention. And then she said, I'm going to wait for house prices to drop before I buy. To which I said, what I always say, for the last 20 years at least, when someone says that, I wouldn't be waiting for house prices to drop. However, you never know. And no one really knows the future, but economists are paid to have a look at it. And we are at a point at the end of the year where people are starting to be putting their ideas forward as to where we're going. And I wanted someone to assist us today at having a look at the wider market and what might be coming down the line in the year ahead. Diana Messina is at AMP. She's an economist at AMP, and I talk to her regularly. I haven't had her on the show before. I've wanted to, and well, it's the ideal day for it. So, I want to, normally I would actually talk a few topics to people at the start of the show, but what I thought I might do was just actually bring up a question here from listeners, from a listener called Sean, which came in a few days ago. I'll read it out, and I think it kind of captures anyway what I wanted to talk to you about, certainly part of what I want to talk to you about. Sean says, house prices have grown prodigiously, substantially outstripping growth in income. Absolutely true, Sean, on the money. This has been great for savvy investors who listen to this podcast, but I'm interested to know what you guys think about it. If this trend keeps going, what might be the broader implications? Okay. House prices have defied every single challenge, not just COVID dramas, but everything else, including this time last year. I don't know where you were on it, Deanna, but the majority of economists still thought house prices would drop in 2023, and in fact, they did anything but. We had 8 months of consecutive rises. Now, I'm at the same time of the year, and the economists largely are saying house prices will rise by about 4% nationally, with all sorts of variations in there. Have you or your house AMP, have you got a setting on this yet?
Oh, well, our base case at the moment, which all economists talk about, their standard forecast is for a rise of about 5% for home prices across the nation next year. I think that's pretty standard now across the board when I look at consensus. But we're actually thinking that maybe the risk is to the downside now. If you look at the daily data for home prices over the past week or two, across Sydney and Melbourne, prices have actually been softening and even declining. And that's in line with some of the auction clearance rates that we've had after the November rate hike, which I think really changed people's expectations about where the RBA could potentially take interest rates, and has led to a lot more concern for households with a mortgage that they're potentially going to be under a lot more stress next year. So the risk is really that maybe we'll actually see a flat year of home price growth, or maybe even negative. Now, we do think that the RBA will actually cut interest rates in the second half of next year. So I think that should provide the housing market with some support, because we know that home prices always react to rate cuts. But at least in the first 6 months of the year, I think the risks are to the downside for prices.
Right. Okay. That's interesting, and I'm across what you're saying, because I did notice myself the clearance rates at auctions are something down around mid-60s now, 65% or so, where you would expect them to be at least 70, between 70 and 80, I would think is healthy. Is there more? More people are trying to sell. So those clearance rates, are they being achieved? What sort of levels of stock are they being achieved on? Is it normal? Is it higher than normal?
No, the stock in the market is still below normal. So we're not seeing as many sellers as usual. So, there's obviously both lower demand for dwellings, but the supply is also quite constrained. So there's probably dynamics around both of those that are leading to lower auction clearance rates. But normally those auction clearance rates are a good sign of sentiment in the housing market. And even when you look at things like what consumers are saying, whether it's a good time to buy a dwelling or not, they're saying that it's actually a really bad time to buy a dwelling, even though their expectations are that home prices will continue to rise in the next 12 months. I think because home prices have generally risen, mostly in Australia, as you were saying, for decades. So it's hard to expect a big fall in prices.
Yeah. And that's the immediate scenario. What about the broader scenario? There's people saying, look, what's happening in Australia is that basically we're getting close to the maximum stretch that the average person can afford to buy a house in terms of how much they'll pay in rent, in terms of how many multiples of their income they will be prepared to borrow on. And we're getting to a point where if we're not close to the top, we're heading towards a Japan-like situation where we could have a flat or drifting market for years and years. What do you think of of that view?
Well, it's definitely a potential scenario that could occur. However, I think that we've kind of been saying that is where the Australian housing market has been now for many years. I mean, if we even look back to pre-COVID times, we were saying that the housing market is very unaffordable in Australia. I mean, it does depend on where you're specifically talking about. If you're talking about capital cities or region, the regions had a huge boom during the COVID pandemic. So they are looking more unaffordable now too. But the affordability issues are really in Sydney and Melbourne. And across some of the other capital cities, it is a little bit better. But the two major capital cities are where the problems are the worst. I kind of think at the moment, maybe we're seeing this intergenerational transfer of wealth between the wealthier baby boomers who are helping kids or grandkids get into the market. Because when I've looked at surveys about people who have recently gone into the housing market, actually quite a large share of those people have said they've either received financial help from family or through things like signing up as a guarantor. So that is still some sort of help in terms of getting into the market. And this could be happening more and more. And maybe this will lead us to the situation where home prices can continue to rise at a softer pace. I think that they will rise at a much slower pace than where they have been, because interest rates are likely to be higher in the next 5 to 10 years than they were in the previous 10 years. So the pace of growth for that asset is going to be lower. But if we see some of this transfer of wealth, perhaps we can still support the market.
Right. I have two things spring to mind there. One is it's the simple issue of the bank of mum and dad. Have you any way of measuring that, or is it almost like by inference because of some gaps that you see in the figures?
Well, it's hard. It is very hard to measure. The only way that I've really seen it play out is within surveys where they've asked recent home buyers who have bought in the last 3 to 5 years how they've paid for a deposit. And it's not really about paying off the mortgage. It's more about actually getting access into the market, because this is where the affordability challenge comes in Australia, that getting that deposit into the market and paying for stamp duty is very unaffordable. Servicing the mortgage is a bit better, but those surveys have shown that a decent share of recent borrowers have received support from the bank of mum and dad. And I think this will be something that continues over the next few years as well, just because the wealth of the older population has surged, and it will probably remain very high if interest rates stay at elevated levels and you can get a 5% rate on a term deposit.
Okay, that's interesting. So in terms of what could keep this market sustained, that's a sort of it's a variable that we can't really measure, but we have to understand that it's there. Yeah, all right. So if we look at the market, if it was 5%, it would be flat anyway, wouldn't it, in real terms? Because inflation is probably hovering around 5%. If you say that interest rates are going to stay higher than we are used to,
higher than what we've been used to in the last 10 years before the pandemic. I mean, if I think about the level of interest rates that I think can be sustainable in Australia, it's probably somewhere at 3 to 3.5% at the moment, so lower than where it is right now. But I think that we are we have interest rates that are too tight for the economy right now. I suppose that's the point of them, to get inflation down. But I think a more normal level of interest rates is 3%, which is obviously much higher than where it was before COVID.
And then for most people, most of the time, that would imply mortgage rates hovering around what, 6, 7?
Probably towards 5 to 6%.
5 to 6%, yeah.
at the moment, the standard variable rate, if you get a discount, is around 6. It'll probably be a bit higher now with the latest RBA rate hike, because we have seen a lot more discounting to mortgage rates in this cycle compared to other cycles.
Yeah.
If you just look at the usual pass through of interest rate hikes to the mortgage rate, it hasn't been as high as usual because there's been much more competition between the banks.
Yeah, I'm starting to believe that there really is competition between the banks because of that issue, and you can see where Combank actually stepped back and said we're not prepared to lose money in that area because the competition was so strong. So I think we have to take it that even though there's only 4 major banks, there is competition in there. Okay, I want to ask you something else. This is more an economist question. It's about all the things they've been trying to do to improve the access that people have to the market, people who don't have bank of mom and dad, and I presume that's the majority, or at least if they don't have a bank of mom and dad that's of suitable scale that's useful to them. Is there anything you think they're trying that they're... Is there anything that you think the policymakers could try that hasn't been tried? We see all these different grants. We see first home borrowing grants. We see attempts to tap super, pretty controversial, to go near the housing market. We see build to rent, etc. Do you see anything that should be tried that isn't?
Yeah, I do, but it's not palatable for politicians, because the 3 things that you really need to do. Well, there's 4 to see a potential change in how housing is an asset here. The first is changes to negative gearing, so cutting it back or restricting it. But we saw that wasn't really supported by the population. The second is to reduce the capital gains tax concession, or to get rid of it altogether, which again was not looked upon favorably by the community. Yeah. The third is to reduce the level of immigration in this country, because at the moment we're running annual population growth that's at 2.5%. It's just way too high for our housing market at the moment. There are real benefits of high immigration, but at a time when you have very constrained supply, it puts too much pressure on rents and too much pressure on supply, really. So
you're on the basis that the 2 tax ones are sort of too dangerous for most politicians, but I imagine the immigration is something that a politician would wade into. Are you saying economically that the benefits of high immigration, which is what we have just now, in terms of job skills, etc., that it would be worth it to neglect that for a while, to return the housing market to something other than this situation where we have 1% vacancy rates, which is absurd?
Well, I don't think that our annual levels of population growth is sustainable. It's running at 550,000 people a year. The government's own permanent migration targets are 190,000 a year, but a lot of the arrivals are coming from temporary visas, but temporary that for more than a year. So you're counted in the population figures. So the government can maintain their permanent migration targets, get those skilled workers in, get the younger workers in to offset the aging population, but reduce the level of temporary immigration to a more sustainable level that won't put so much pressure on the housing market or on things like infrastructure. And the last thing that the government could also consider is changing stamp duty requirements, which was tried in some states, to get rid of stamp duty and replace it with a land tax to assist that initial getting into the market that I was speaking about as very unaffordable.
Can I ask you just one last thing on the immigration issue? They would say that they were catching up because obviously the borders were closed for some time. Do you know numerically if we have caught up?
Well, yes, we have, in terms of where our population could have been compared to pre-COVID time. Yes, we have caught up to those levels now.
Right. Okay. Very interesting. Very interesting. Well, actually, now, just while we're on that, one of the other things we've been looking at on the show, and obviously people listening to the show are property investors. And they're property investors on the basis that that's the world presented to them. And that's the deal, that you do the work, you go into the market, your yield is not great. Cash might even be better. In fact, cash is better, I think, in many cases already. But the deal is that you get tax breaks, and when you sell, in the end, you get a CGT discount as well, which is a hell of a lot lower than your income tax rate. That's the deal. Everyone puts it on the table. But I wanted to ask you that inside that, then, one of the things that is happening is how there's this whole return to shared accommodation and sharing houses and lodgers, which is something I would think of as something from like old movies in the 1930s. It was always lodgers and landladies. Are we heading back to that?
Well, we probably are, because during the pandemic, the household size ended up falling. So I think that the household size will start to increase again, and also it probably has to, because the housing rental market is just becoming too unaffordable and too tight. Rental vacancy rates pretty much all sub 1% in most capital cities. They have improved a little bit, but not really too much. So the only way is if you get this shared accommodation.
Yes. So that's a trend you think will continue into the market. Is there an investment dimension to that? Do people, would it change the outlook for investors?
Well, there are types of accommodation that investors can look at, things like student accommodation that the government's trying to increase its building of as well. So there are definitely avenues, but that would be more from like a real assets point of view rather than something. I don't know if many of those are listed or if you have to go to them directly through a property portfolio manager.
Yes, that's something we must bring on the show. We must actually cover that student accommodation and try and cover it in a way that both sides get an explanation, because some people think it's great and some people think they wouldn't go near it and they have had bad experiences in it. Okay, so just looking back at that segment that we've just finished, folks, I'm just thinking about what I think. I've heard from Deanna that is basically moving the issues forward. Very interesting, I thought, about how next year and going forward, can property prices keep rising? Perhaps a variable that we don't understand and don't take account of is the bank of mom and dad. We can't measure that, as she says, but it's alive and kicking and very real, and is actually could be a potential source of deposits, basically, which means that the market can keep rising. That's something that's very interesting. One of the reasons that the market was rising this year was immigration. There's an extraordinary number of people came into the country. I mean, a substantial city basically came in through the airports in the last year. An element of that is catch up. There is a debate forming about whether that should change. Certainly, if it is reduced, it will reduce rental demand, particularly because immigrants rent when they arrive. They don't get off a plane and buy a house. So maybe the rental market may change a little from a 1% variable, 1% vacancy rate, which basically is a market where you can rent anything. What's a natural vacancy rate, do you think, in the property market? Normal. What's normal?
Well, I mean, the long-term average for Australian capital cities is probably somewhere between 4 to 5%. That's more of a normal rate across the nation. In some capital cities, it will be lower or higher. Obviously, it usually is lower in Sydney or Melbourne, but across the nation, it hovers somewhere between 4 to 5%. And I think that's the type of yield that investors would be anticipating as well when they're thinking about rental income.
They would be thinking of a yield of 4 or 5%.
Well, obviously, it depends on where interest rates are. But if you think about, a normal rate of inflation, that's 2.5%, and then you add some extra on top of that, I think that's the type of, that would be a more normal type of yield. Right.
So we haven't had normal yields for a while then, and we haven't had normal interest rates or normal inflation rates. Maybe this is why people have a sense that it's heading into uncharted waters, but maybe we're just heading into entirely conventional economic waters. Like we've seen in the past. It's just that it was so long ago since we saw it. What do you think of that notion?
Well, the next 10 years, investors have to get used to higher interest rates. And that has big implications actually for growth assets, because the last 10 years of easy money has really allowed a massive tailwind for fixed income and for the real assets market. But because their valuations are based on those interest rates, and even for things like growth stocks, But in the next 10 years, I think that story will change. And you already, I mean, you kind of saw that shift sort of in the last few years in the share market, but a lot of those tech AI stocks have still done extremely well, and they're growth stocks that are correlated to the bond yield. But I think that in the next 10 years, generally, fixed income and real assets should have a lower rate of return just because interest rates are going to be higher.
But also, does it mean, Deanna, that for a property investor that their yields may improve, but their end price when they sell won't be as good as it might? Is that it?
It depends on what you're looking for. I'm talking total returns. The overall rate might be a little bit lower, but income returns will be high, yes, for both fixed income and then for things like real assets where you're looking for that yield. But investors also need to think about the capital growth that goes into their investment.
Yeah, and the real asset is a rental investment property is a real asset. That's under your definition.
Yes, it is. Yeah.
Yeah. Just to clarify for everybody. Very interesting issues there in the first part. I have to say, as a property investor, I think the outstanding issue to bear in mind is that yields from property may improve in the scenario we think we're heading into, but the final price you get, the capital appreciation you get, may not be as good as it used to be. I think that's a very, very powerful, a very fundamental change if it does happen, and all the indicators are that that's where we're heading towards. So keep that in mind as an investor. All right, question from Seamus. I have a question relating to a frequent comment made about property investors fleeing the market, particularly in Victoria. My question is, if a property investor sells a property to a first homeowner or an owner-occupier, does the demand for a rental in that instance simply net out to zero? It's pretty interesting, Deanna. We have thought about this. Like, if it's come in many times, people come in and ask this question. We say landlords or property owners are holding back. They're not going into the market. They're leaving the market. And some people will say that's very bad because the provision of rental stock will drop. And then other people say, oh, that's great. That means people are buying their homes. They can all leave, and it'll be cheaper for us to buy a house. Economically, what does an absence or a reduction of property investors mean in a market like ours?
Generally, property investors help to increase new construction, and that's why we had initially implemented policies like negative gearing to get new construction up, because property investors can deduct the depreciation, and that mainly is done on new dwellings. So generally speaking, if there's a long-term decline in the level of property investment in real assets or in the housing market, then that would be negative for new construction.
That's what's going on at the moment, right? Because the property investors are not there. Compared to a few years ago, they are reticent, shall we say, in the face of rising interest rates. So that means less supply on that front. Okay, yeah. So I suppose the question from the average investor or the everyday investor, and a question from Seamus or any listener, and this is always information, folks, not advice. But is it not the case then if a cohort of property owners exit the market and those properties are bought by owner-occupiers, do you track that sort of thing? Is there increased home ownership as a sheer one? No.
That's very hard to trace. And you can track transactions in the property market, but actually it's really hard to see, the flow of transactions. We can see the level of lending that's done to different owner occupiers or to investors, but in terms of the change, that's very hard to know.
Right. So it's probably a trend, but it's unclear. It's very hard to get hard numbers on it. Is that basically it? Okay.
Yeah. All right. I think if you saw a big increase in lending towards investors, then you would probably assume that there are more investors in the market than owner occupiers. And I think that we did see that before 2017, before the APRA rules changed around interest-only loans to investors. There was a very big increase in investors in the market. And also, I guess, because interest rates were so low, obviously the affordability question became a lot easier. But investor lending has been pretty soft in the past year.
Okay. Yeah, and it is. I don't want to put words in your mouth, but is it a backbone of supply? Because it seems to me it is. If the vast majority of rental property in Australia is owned by private investors, then it would seem to me private investors are the backbone of the supply outside of public housing.
I don't know if they're, I guess it's hard to say whether they're the backbone, but they are a very large share of private housing. But then that then tells you that the government needs to have more of a say. I mean, I guess that's an argument then. Should we be outsourcing housing to the government? But I think the government has let down the housing sector because we haven't been building enough properties, whether that's outsourcing it to actually the government to do the construction, or whether it's just a fault of the government that they haven't been on top of the approval process as much and working with the state governments to release land. That's more of my issue, that the government needs to step in and actually allow us to build more on the land that we have.
Okay, yeah, to accelerate the building's approval and commencement process. Yes, okay, that's clear. All right, question from Andrew, which is not economic as such, but let me read it first of all. Andrew says, if my super was filled with a property and the property was valued at 4 million and I agreed to pay the 1 million unrealized gain tax out of my bank account, this is the looming tax on earnings on super above 3 at 15%. What would then happen the following year if nothing changed and the property was still worth exactly 4? I would imagine you have nothing to pay if there was no change. And to clarify further, if in the third year, what amount would then be taxed as unrealized if the property were valued at 5? And to Andrew and everybody else who has the issue or the looming issue of what's going to happen, how's it going to work, how are they going to tax these unrealized gains on property in super. We've got the draft legislation, and how it's going to work is like how capital gains tax works. If you make a loss, you can only write that off against a future profit inside the system. Just like inside capital gains tax, this will be the same thing. There's no refunds. So when you pay tax, that goes against you individually or your super fund. You can go either way. It's like Division 293, right? So you can pay it out of your pocket or you can pay it out of your super fund. If you make a loss, though, I'm sorry, they don't send you a check and say, sorry, here's a check for you because you made a loss. You have to roll it up and claim it in the future, carry it forward against any future gains. Those two issues are two of the outstanding issues that are driving people crazy about this. What's really driving people crazy is that it's a tax on unrealized gains as it stands, which is against all tax principles, as I understand, certainly from the Tax Institute and everybody else. And they say there's nothing quite like it, and they hope it doesn't get through in the shape it's going through Parliament. There are frantic efforts, Andrew, and anyone else interested in this, behind the scenes to try and find something else. Like a deeming rate, for instance, has been suggested, which is probably good in principle, but in effect, our deeming rates currently are very low. And transposing those very low deeming rates into people who have more than 3 million in super might create another political problem. So we'll see where that one goes to. Would you like to add anything to that particularly hot subject, Deanna?
I better not touch the personal finance stuff, James, but no, I think you said about the deeming rates.
Yeah. Well, yes. So anyway, that's what's going on. I'm in touch with the various people who are in touch with various members of Parliament, trying to persuade them to amend the legislation for this bill. Not so much because of what it is, but of what it introduces, which is a tax on unrealized gains, which nobody would like to pay that, no matter how much you have. Okay, I will take a short break. Final question from Simon in a moment. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, wealth editor at The Australian, and I'm with Deanna Messina, the economist at AMP. And we are talking property. We are talking how we could improve the supply of property, and Deanna listed a string of things that have come up many times. Capital gains tax, negative gearing. Nobody will go near them, I'm afraid, politically. I don't think so. After Bill Shorten lost an ALP when he was leader, when he lost an election on the basis of that and frank dividend reform, it's probably too early to go back in there, I would think, for politicians. But interesting subjects all the same. And also some very interesting observations she made about the market. She thinks the risk is on the downside to those forecasts of 4 and 5% for the market next year. But she doesn't seriously question the direction of the market, which I think is interesting. Okay, the final question is from Simon. I'm a share investor trying to expand my knowledge of other investment types. I've been hearing on other podcasts about senior secured loans, which rank ahead of bonds in the capital structure of a company. Can you explain how this is possible? Look, Simon, that's probably that's a very detailed question. I would just say just about this whole area of of bonds and other areas of income. The Australian everyday investor is being forced, I think, by the rise in interest rates and the very spotty returns of the Australian share market to look at alternative assets, bonds, and other assets of that nature. Bonds is a world within a world, and quite difficult to go into in a proper, diversified way as an everyday investor, apart from ETFs, which create their own problems. That's one thing I want to put on the table. And the other issue is that on the broader front of fixed income through any form, from secured loans across to whatever, secured mortgages, whatever way you want to go in, private debt, it's an area that most investors are not familiar with in our market, because they have traditionally been either arcane or restricted to very, very wealthy people. So careful in that area, and really try to figure out that you know what you're doing before making any decisions there. I would say that to Simon and everybody else. Deanna, just to finish up, when we look at our market, it was always about cash and shares and property for many people most of the time. And one of the things I think that comes across talking to you today, which is really interesting, which everyone should keep in mind, is that we were in a strange, odd era for the last 10 years. Folks, interest rates were coming to zero. People were paying to have money in banks. That was very, very, very unusual, probably unprecedented in modern history at least. And what Dina is saying to a degree is that we're coming back to normal, where your mortgage rate is 6% or so. Can I just ask you, so for the investor, is it worth going off and learning and finding out about that part of the market that was asleep for so long because it didn't matter because interest rates were so low?
But the income part of the market.
Yeah, the fixed income part of the market, which people really didn't have to think about because it was asleep, wasn't it really? It was dormant, effectively, for the majority of the last decade.
The capital growth for fixed income did really well. The capital component of bonds did extremely well because you had a huge fall in yields and that increased the actual value. But obviously that income component didn't do so well. So fixed income investment has actually done pretty good in total returns in the past, before the period of the pandemic. It's just that the income component wasn't very high because interest rates were low. I mean, ultimately for investors, it depends on what you want. Do you need that income, or do you have a long-term horizon? It just depends what stage of life you're in.
That's a really interesting point, because I suppose traditionally people in our market use the banks as proxy bonds. And if you think about it, folks, what Deanna is saying is, what do you really want? If you've got NAB, it's the same price. It's the same price forever. It's $27 forever at NAB, but you're getting a 5, 6, 7% income. So people use it almost like a bond. And perhaps there's going to be more of that in the future, where people look at other investments, probably safer. That is, when I say safer, I mean higher investment grade in relation to bond ranking, etc. But people will probably start thinking about the income dimension of fixed return much more than they used to, because it's probably becoming more reliable Is that broadly what you're saying? That the income part, the traditional part where they say we're going to pay you 4% forever or 5% forever is more reliable than chancing your arm on total returns?
Well, in the short term, yes. I mean, the risk for bonds, at least in the next 12 months, is that we do get a recession. And if we get a recession, then interest rates are likely to be cut, so yields will go down. So the income, I guess, if you're locked in at that income, then you would be okay. But the income component could actually go down in the next 12 months, but then that would increase the capital value because rates would be cut. And I think a lot of investors are still concerned that bond yields could go higher in the near term. I mean, we've seen the past few months, yields have really oscillated quite a lot, and we saw that yields were rising even despite the fact that central banks around the world were mostly on hold. I mean, we're talking about the US. They're kind of the first one that we look at or think about when we think about the long-term trends of interest rates. And the US Fed's been on hold in the past few months, but US 10-year yield reached 5% because of other issues, concerns around the US debt situation, higher yields on Japanese bonds. And I think that there could still be some short-term upside for yields because of these concerns, even if central banks are on hold. But generally speaking, obviously the yields on fixed income look so much more attractive now.
Okay, good point and a very clear point. So keep that in mind, folks. The yields, which is what it's all about on that side of the market for the everyday investor, should be at least, are better, are higher, because we are in a higher interest rate environment. Okay, Simon, I know we wandered a bit around that one, but I think it was probably more useful to the larger audience to talk about those issues. Thank you, everybody, for your questions. Andrew, Simon, and everyone that wrote in over the last week. Okay, folks, keep those emails rolling. You know the address, themoneypuzzle@theaustralian.com.au, and you can listen, of course, to our podcast, and indeed you can watch them now on YouTube. Have a look. Thank you. Talk to you soon.